So when you're attempting to trade, it can be a little bit confusing. You're looking on your Betfair charts, you're looking at different markets, and you're sort of thinking, what am I supposed to do? Which direction is it going in? And you know, and people just get sort of frozen at that particular point, confused, and end up sort of doing fairly random stuff, which of course doesn't end up in a profit. Now, I did a little trade this week that sort of exemplifies exactly what you should be doing and what you're attempting to do at any one particular point in time. So what I want to do in this video is review that trade to give you a much better understanding of what I did and why. So it can be confusing when you're actively trading because a lot of stuff doesn't seem to make any sense. I very often see this mistake that new traders make, that they turn up to a market and they feel like they've got to do something. They're trying to understand what is going on in front of the screen, in front of them. And the interesting thing is very often you don't actually need to do this. You're under no obligation to trade the market in front of you. And I'd say that this is one of the first tricks that you must learn. If you turn up to a market and you look at that market and you're thinking, I have no idea what's going to happen next or what I should be doing, then don't trade it. Because you need to approach each market with a specific trading plan, an idea of what you're going to do. And in order to keep your emotions in check, you need to be able to say, right, this is what I think is going to happen into the market. This is where I know that this trade will be a success. And this is where I will know if this trade is going to fail. And if you approach a market like that, then it becomes quite easy to understand when it's gone wrong and when it's going right. And then you can execute against that particular trade. So that's a really important thing to understand. However, there's another really important thing to understand as well, and that is how you approach each of these individual markets and exactly what you should be looking for. So let's examine that next. So people often say to me, well, what should I be looking for? And there are two approaches to this, because my answer to that is going to be different from what your answer should be. Because I've traded so many markets, hundreds of thousands of markets, I can turn up to a market and I look at it and I go, okay, I recognize this. I've sort of seen this before. I understand what I'm looking at. And then I put a strategy into that market. I say, right, this is what I'm going to do. This is how it will work. This is what would be a success. This is what would be a failure. So when I turn up to a market, that's the process that I go through. However, if you're just starting out, that is exactly what you shouldn't be doing, because you will not be able to solve that puzzle. You're looking at a complex market with many different facets to it. And in a lot of videos, what I try and do for you is I try and say to you, oh, have a look at this, understand the way that this works. This is interesting. This is what is influencing the price action here, and so on. But when you turn up to a market, to try and digest and turn that into a strategy is quite difficult. So what I suggest is that you do the exact opposite if you're starting out on trading. You find a strategy that I've demonstrated or something that I've shown that you like, and then you look for a market where you can deploy that particular strategy. So, I'm going to demonstrate a strategy in a second that recurs several times over, and I have done videos on this before, so I will link you to those videos as well so that you can see that this is a repeating pattern. But what you should be doing is you should be saying, right, okay, I understand the strategy, I've watched the videos, I really understand what I'm looking for. And then you have to wait for that opportunity to occur in the market. This is one of the great ways that you can trade, because if you deployed this strategy in every single market and did exactly the same thing in every market, you will not make any money, because some markets it would work well in and other markets it will not work well in. So part of this trade actually begins before you actually start the trade. You turn up to a market, you see if the market is exhibiting the characteristics that I'm about to point out to you. And if they are, and you're confident that you understand what you're seeing, then you can actually start doing that particular trade. There's no obligation for you to trade. And in fact, not trading a market because you're uncertain about what you're looking at is a great way of reducing your losses in the long term. And this is all part of the trading process. You don't have to trade every market. And in fact, when you're starting out, you'll probably skip more markets than you actively trade. But if you wait for the right opportunity to come along, you will almost certainly find it, because there are so many opportunities to do these trades, so many markets taking place all of the time. So yeah, when you understand a strategy, when you've practiced that strategy, you may still be a little bit behind the curve, but you'll get better and better at executing that strategy. And your focus should be on doing that particularly well, but also finding that opportunity when it occurs. And if you don't see it, you don't have to trade it. So without further ado, let's actually have a look at this trade and understand exactly what I was attempting to do. So there are a number of things that interest me in this market. The first one is, as we've turned up to this market, you can see that it's at a crossover point. So if I lay at a crossover point, then it's 2 to 1 in my favour. Basically, the price could go against me a fair bit, and it wouldn't matter as much as if it was at some other point within the market. Also, have a look at the volume to the right, because the volume on the right hand side here, you can see about 50% of the money in the market has been matched at or around these levels. And that's very relevant, because if we look at the chart on the right hand side here, you can actually see that the price has come in from a higher price and is sort of stuck in a traded range at or around 2. There's a little bit of money has been matched below it. But fundamentally speaking, you can sort of see the market saying to you, you know what, this is far enough. I don't really want to go any further at this particular point. But of course, we need some sort of confirmation of that. But the other interesting thing about this market is it's a maiden race. So this will be horses that haven't won before. There may be some unraced horses in this particular race, or it could be that they're just not very good quality horses and therefore they haven't won at all. And you tend to find, because of that, these markets tend to be a little bit volatile. So we have a number of factors there that do interest us in this market. And the way that I'm approaching this market is to say I'm going to put my orders in at or around 2, and I'm going to basically wait for the price to start moving up. Now, it's important when we look at the market in that particular context that when, or if the price actually went against us, we would have a defined exit. So my defined exit in this market would be about 1.9. But on the upside, I would expect it to go higher, because it's been up there before and people were willing to lay it at that particular price. So there's the possibility of it heading back up in that particular direction. It just needs us to establish if there's enough sort of laying support at this level. People are looking at the odds of 2 and saying, well, that's far enough, you know, I'm going to lay it at that point. Or it could be that people just aren't backing it anymore at this particular point. But that's the basis on which we're entering this trade. So the first thing we do is establish some positions within the market. So I've now established a full position in the market, and I'm anticipating that basically the price is going to go up, but also that the volume is going to increase, which it will do. The volume on this market is very low because another race is running at the moment. But that hasn't stopped us from establishing a position, because our planned exit is in a few minutes' time when the volume will be a little bit higher. But what I'm going to do is place the orders in the market, and the reason I'm doing this is that's an optional close for me. This is roughly where I think the price is going to go, and each of these orders scattered up the side of the market here mean that if the price moves quickly, I can cancel them, but if they don't, I'm near the front of the queue and we'll get those orders filled fairly quickly. And that is what will make this trade successful. It doesn't have to go up in a straight line, it can just meander around that price. But basically, when the money begins to arrive seriously, it breaks down, then we'll just basically dump our position. It's pretty much as simple as that in terms of framing this trade. So we're now approaching the period when we're going to get a lot more money through the market. We should see an acceleration in activity and confirmation that our trade is working here. And if we don't, then we basically just dump the position. We just get rid of it as quickly as possible. So you can start to see the orders getting taken here. And you can just see I've adjusted the ladder and optimistically put some orders much higher up. But what I'm trying to do now is I'm trying to get the net stake position balanced with the amount of unmatched bets. So you'll see me popping in new orders here just to balance out those two. And one more order here will basically get the two matched up. And then it's just a question of sitting and waiting. But if you look on the left-hand side, you'll see the green space increasing as the trade starts to go into profit. So it's not moving dramatically in our favour on this particular occasion. But you can actually see that the green space on the right is basically extending down all of the time that we basically get those trades matched. And that means the chance of us having a negative trade here is decreasing by the second. So as long as I can get these orders matched, I'm going to try and get them matched at the best price that I can. But basically, if it doesn't move up particularly far, then I'll just put orders in much lower down and cancel the ones that are above it. But the process of doing this means that each order that is getting matched gets matched at a good average price, not the perfect price, but a good average price. And eventually it reaches the point where it's very, very unlikely that we're going to lose money on this particular trade. And like I said before, if the market broke down convincingly, which it didn't on this occasion, then we would just exit that trade. But the way to look at this particular trade is, we're going to do this, we're going to squeeze every penny that we can out of it. And on some occasions, it's not going to work quite this way, and that could be for any particular reason. But the fact is, over a long sequence of events, the two balance each other out. You've just got to not let those losing trades get to you. You didn't do anything wrong, you were probably doing the right thing, and it just didn't work out. But as you can see, that this trade is actually working out in our favour. And as these last few orders fill, we'll end up with a decent profit, a fully hedged profit in the region of about £80 odd. And yeah, I mean, it's a fairly sort of simple, self-explanatory trade. We've basically looked at what's going on within the market. We've decided it's probably not going to get any further. We don't know particularly how far it will go, because that will be a factor of time and the amount of activity in the market. But it's netted us £184 unhedged, or about £80 odd if we fully hedge that position. So let me round off this video for you. What I was looking for here was where the price on something had come all the way in, and basically I could see that it wasn't going to go any further. This was enhanced by the fact that it was at a crossover point, which meant that it was 2 to 1 in my favour if I was laying. So I'm basically saying the price has come from here, it's come all the way down to here, it doesn't appear to be going any further, and because it's sort of 2 to 1 in my favour at the crossover point, then it would be nice to get a lay position in. So I was looking for that activity to die down, for the price to not go any further. If the price had gone further, then I would have just cut it for a loss, but it didn't. So all I did was put my exit orders above where my entry point was, to try and get the best average price that I could out of that market. Now, I could have entered at this point and exited at that point, but the problem is the market wobbles around a lot, and very often the price will go out and come back and so on. So you're not interested in being perfect. I've never had that as one of my key aims. I'm basically saying this is roughly where I'm going to get in, this is roughly where I'm going to get out, and I will get a good trade out of it, and I won't get freaked out by the volatility that we see in the interim. So yeah, once I'd figured out where I wanted to be roughly in the market, I put those trades into the market, put the closing trades above it, and then basically those orders got taken out as the price meandered upwards from there. And in fact, what actually happened after this is the price did start to come back down again. But that didn't matter, because when you're trading, you're just exploiting that volatility, not being freaked out by it or trying to be perfect and catch the top and the bottom. You're just playing around inside the market at those key points. So yeah, it was a strategy that was very clear, but this doesn't occur in every single market, and the quality of these opportunities vary a lot. So once you understand the strategy and you understand what you're attempting to do, you've just got to look for markets where you can deploy this strategy. And on this particular day, I took one look at this market and thought, I know exactly what I'm going to do here, or what I'm looking for. Waited for that confirmation to sort of get baked into the market, and then initiated my trade. And that was all that I did. This could have been the only trade that I did all day if I was using this particular strategy. But when I started trading out, I would solve all of these problems one by one until I get to the point now where I can turn up to market and I know roughly what I should be doing. But this is a good example of a strategy that doesn't occur all of that time, but when you see the opportunity, it's a really good one.